Hi, good day everyone, and welcome to our pre-recorded lesson or tutorial for unit number 3, which is expected return and standard deviation under the topic risk and return. So in today's lesson, we'll be taking a look in terms of how to calculate expected return as well as standard deviation. We'll be looking in terms of a single asset as well as a two assets portfolio, where you'll have to decide whether to include a specific new asset or security in your portfolio to actually diversify your portfolio by actually reducing the risk. So in this lesson, we are going to be taking a look at all those elements. So we're going to start with the first tutorial, which looks at the single assets. And then the second question will be looking at a two assets investment. So let's take a look at the first one. So here it says that based on various scenario planning and economic forecast, the probability of various state of the economy has been determined by an economic analyst. The various possible state of the economy depend upon factors such as national debt, foreign investment prospect, and internal political factors. So the financial manager of Plus 2 Ltd, manufacturer of fashion wear for teenagers, have predicated the most likely return to shareholders given the state of the economy. So based on the economic analyst of this company, he have managed to identify that every time when the state of the economy is under boom, the company earn an anticipated return or normally earn an average return of 60%, and the likelihood of this occurring based on previous event is actually 5%. And when the state of the economy is under strong economy, uh, we normally receive an average of 40% return for our shareholders, and the probability of this occurring is actually 15%. Whereas under moderate economy, the state of the economy, the probability of this occurring is 60%, which means that this is mostly the likely one that normally occurs or that we are currently in. And the normal anticipated return is 25%. So what this actually means is to say that when the state of the economy is under moderate, uh, on the previous historic return that have been looked into by our financial analyst, they have identified that through geometric and arithmetic mean, the average return for this company based on historic return is actually 25%. So this means that there is a likelihood that we can earn 25% when the state of the economy is under moderate. And then under recession, we are going to say that when the state of the economy is under recession, the company will therefore have different outcome, though it might not be 5%. It might be 10% based on the historic return. It might be 15, it might be 5, it might be 6, it might be 4. However, after applying the geometric or the arithmetic historic average return, it have came up to 5%. So this means that this is the average return that it is anticipated during recession period. So therefore, we can also anticipate that during the recession period, the company is likely to earn a 5% return for the shareholders, whereas under deep recession, it's a minus 10%. So based on our requirement, we are then required to calculate the expected return, the variance of the expected return, as well as the standard deviation of the expected return, which then gives us what we call the risk of the assets. So over here, we then have the following three formulas. The first formula actually being the formula to calculate what we call the expected return, which is the sum of the probability multiplied by the anticipated return of that individual outcome. So here we're talking about the probability for the boom, which is the state of the economy, and then as well multiplied by the anticipated return, where the years of the anticipated return will start from 1 to 4, where I start from 1 to 4 or going upwards. And then on this other formula, this is what we call a variance formula, which requires us to calculate the sum of the probability multiplied by the uh, anticipated return minus the expected return, all of these squared. So this means that first, what this actually means, what is inside the bracket is then what we call a deviation. So we first need to identify what is the deviation from the anticipated to the expected. And from there, we square root the deviation, then multiply by the probability to get the variance. And then the last formula is actually the what we call coefficient of variation. So with the coefficient of variation, what it actually measures for us, what this actually then measures for us is as follows. So the coefficient of variation then actually it measures how each return will vary from expected return. So what this actually means is to say that for each and every percent of return that the company actually expect, investors could actually expect the returns to vary by a specific coefficient of variation, which is what this ratio will therefore calculate. To say that if it is 2, it means that for each and every 1% of return we will expect that return to vary by 2%. So that's what the coefficient of variation measure. And therefore, we expect this ratio to be very low to indicate the difference of risk between the return and the of the return and the risk. To say that if the risk is higher, therefore we expect the returns variation to actually be to be higher as well, meaning that there is a likely high risk that we might not actually earn our return based on the CV, based on what it tells us for each and every percentage within our return. To say that if the CV is 5%, and it's 5%, and then our return is also 5%. So what it just actually means is to say that for each and every 1% of return, we expect it to vary by 5%. So therefore, which means that that is actually bad for this particular investment. So therefore, we always expect that the CV becomes, we only accept the CV that is under, which is actually lower than the other investment that we are considering, or will actually accept the project that will actually lower the CV of our current portfolio, or the one with the lowest CV if we're choosing between different investments. So let's take a look at our example over here. So to calculate the expected return, which is our first requirement, we're then going to apply this formula over here, which is to say the risk, which is to say the probability multiplied by the anticipated return will therefore give us the expected return under a specific state of the economy. So on the first one, it's going to say equals to 5% multiplied by 60%, which then give us 3%. So this means that during the state of the economy when it's under boom, we expect an average return of 3%. And then we can perform this for the rest, which then tells us that during the state of the economy under 6%, under strong, we can expect an average of 6%. So that's 15 multiplied by 40. And then under the moderate, we can expect 60 multiplied by 25, giving us an average of 25%. On the overall, the expected return will actually be the sum of all of these expected return per outcome or per state of the economy. So therefore, we can go and sum them up, which then gives us a total expected return of 24.25%. So from the expected return, we are required to calculate the variance. But before we calculate the variance, we then first have to calculate what we call the deviation. From the deviation, we can then go and calculate what our variance per state of the economy, and then we can calculate the total variance for the total security, which is these company shares, and then calculate what we call the standard deviation. So to calculate the deviation, we're going to say it's equals to the anticipated return minus the expected return, which is then going to give us 35.75. So this just tells us that uh, from 60%, we're going to deviate by 35.75%, which this amount is a negative in terms of this particular outcome, because on this outcome we expect 60. However, the expected for the whole asset it's actually 24.25%, which means that we're deviating by 35.75 from 60% to 24%. So when the amount over here is positive, it represents a negativity towards the particular outcome, whereas in its negative, it represents a positive outcome. So you will notice this as we continue when we reach a stage where the anticipated outcome is actually smaller than what, or it's actually much smaller than what we call the anticipated. Therefore, it will indicate that there is a growth rate from the anticipated to the expected. So in this case, I'm just going to fix my formula so that I do not get to um, take too much time explaining the same concept over and over. So over here, we're then going to then over here, we're then going to have the deviation for the strong economy from the when the state of the economy is under strong being 15.75%, which is 40% minus 24.25%, giving us 15.75%. So this is still a negativity because we anticipated 40%. However, we are going to only achieve a 24 or an average of 24.25 from this investment. So therefore, we deviated by 15.75% from what we anticipated. Whereas on the state of the economy, when it's actually under 25%, we're only deviating by 0.75%. And then when the state of the economy is 5%, sorry, it's under recession, we anticipate a return of 5%, and therefore we are going to deviate by 90 minus 19.25, which is actually a positive outcome to say that we are going from 5% to 24.25%, which then tells us that during this state of the economy, we can then actually expect um, the whole company portfolio to grow by 19.25%. Whereas under depreciation, we're seeing that from minus 10% to 24, this is minus 34.25%. And then this then brings us to our last calculation, which is the variance for this for number B. So to calculate the variance, it is therefore the sum, it is the probability multiplied by the deviation squared. So it is equals to the probability multiplied by the open brackets deviation to the power of 2. So you will notice that in most cases, your number will be sitting in this format, which is 0.0064, which then indicates that we have multiplied a percentage by a percentage. So just to quickly show you something over here. So if we go and say 100 multiplied by 100, this will then give us 10,000. So this just actually then tells us that when we square root the deviation from 35.75%, our final figure will therefore be in what? 10,000 format. So therefore, to cancel this 10,000 format, we then go and multiply this figure by what? By 10,000. Therefore, this figure will therefore give us the exact amount in percentage format to say that our variance for this particular state of the or state of outcome, which is boom, is 63.90%. So using a scientific calculator, if we're to put this in our scientific calculator, this is what would have happened. We're going to say 5%. So it was going to say 5% multiplied by in brackets 36% to the power of 2. So which then 36%, which then goes to 0.0648, which therefore indicates that the percentage that have been squared is now within the thousand format. So how do we know that? We calculate the digits before the last number. So we're going to have 1, 2, 3, and then these are the two digits that we normally have. So after these digits, you'll see that we then have three digits. So to convert this back, we do know that 100 multiplied by 100 is 10,000. So therefore, we can therefore go and then multiply this by 10,000 to give us the full amount in percentage format. So here I'm saying 36% because I'm rounding off the 35.75. So however, you will not be required to round off. You will be required to round off to two decimal or four decimal. So please make sure you normally use two to four decimal in this activity so that you can get a great answer. So over here, we then have a variance being 63.90, and then we can then continue to repeat this up until depreciation, which is the state of the economy, which is the last state of the economy, to say that what is the variance in this particular area. So it is important to note that when it comes to deviation, you're going to have both positive and negative deviation, whereas the positive indicate a negative outcome, whereas the negative represent the positive outcome to say that there is actually an increase from what we anticipated overall in terms of the overall portfolio from minus 10% to 24. So there is a positive increase by 34.25% to achieve the expected return of the in this portfolio. So over here on the variance, so we're going to repeat the same thing. So when we repeat the same thing, so these are going to be our variance. Over here, it's going to be the probability multiplied by our deviation squared, then multiplied by 10,000 to give us the full accurate figure in in percentage format. So this is in percentage format to say that this is 37.20%, this is 0.33%, and this is 55%, this is 58%. And then once we have got our variance, we can therefore calculate the total variance of this project. So to calculate the total variance of the project, we're going to sum up all the variance based on the state of the economy. This will then give us 215%. So this is the total variation of how much this project will actually vary by. So therefore, to get the risk of this project, we then go and calculate the square root. So I'm just going to type in square root, and then say square root of 215, which then gives us 14.69. So we can still go and confirm this by going on this side and say square root of 215.69. This is going to give us 14.686, which therefore is the same equivalent to 14.69. So this is our risk or standard deviation, which is the square root of our variance. So this is how you get to use the tabular format to then calculate the variance as well as the standard deviation. However, other people prefer that they use a method where they do not go and apply the deviation first and identify the deviance. They just go and use the whole formula as it is to actually come up to the final answer, which is the total variance, which it is still correct. You can still not apply the formula and just apply the straightforward method, and then later on square root your variance to get the standard deviation. So what this tells us is to say that we expect an average of 24.25% and a risk of 14.69%. So this means that when we compare this project with another project, we will therefore then compare how much return is the other project offering, and then how much is the risk associated with the return of that project. And then later we'll then perform what we call the CV, which is the coefficient of variation, which in this case is actually going to be standard deviation divided by by the expected return. So in this case, um, so I'm not sure of this, but I'm just gonna quickly use my other calculator, which is going to say 14.69 divided by 24.25. So this is equaling to 0.61. So this is 0.61. So what this tells us is to say that for each and every percent of return that we will earn on this project, we expect the return to actually vary by 0.61. So that's what this actually tells us. So I'm just going to repeat this. Under the CV, what the CV actually tells us is to say that for every 1% return that the company will actually receive, the investor can expect return to vary by 0.61%. So this is to say that if we're going to earn 24.25%, therefore we can expect this to vary by 0.61%, which means it does not add much effect into our expected return. So the likelihood of us earning this are very high because the variation in the risk associated with us earning this is actually very low compared to the return that we're going to generate over this project. So this means that there is a likelihood or a smaller guarantee that we will earn enough return on this project. However, if the CV is more than one, this means that when it continues to be above one, we expect the return to actually be lesser compared to what we anticipate to actually earn because of the variation. So the coefficient of variation measures us the risk associated with each and every return that we actually get to expect. So this is all in terms of what we call single asset investment. However, the most important thing that you need to understand is that we only use the CV if we are going to invest into, let's say, or acquire a company 100% of that company shares. If we're taking a look at comparing between two assets, we can use the CV to measure the risk associated with 1% or whichever return that we're going to earn over the project and choose the one that have got the lowest what coefficient of variation, because the one with the lowest indicate that there is a likelihood of us earning all of the expected return or a guarantee that we will earn the returns over that particular project, whereas the one with the higher CV indicates that there is a higher risk of us not actually earning those full expected return. So if you are going to only acquire 60% of an investment and add it to your company, though you will have controlling, right? It is going to be very much important to note that you cannot go and be able to use the CV to measure that. So what actually then for happen is that you will therefore have to measure that through what we call the portfolio variance as well as standard deviation of a portfolio, which you're going to measure the previous risk of your single investment assets as well as the risk of your combined assets, which therefore becomes your portfolio risk. And that will actually then tell you whether your investment that you actually invested into have managed to reduce the risk or have add on the risk in your assets. But if you're acquiring 100% of another company, it is also important that you also perform the coefficient of variation, because now that company is going to become one thing with your company. Therefore, this therefore means that you also need to calculate the coefficient of variation to see what is the likelihood of the new company's risk in terms of expected return, in terms of variation, how much will they vary by once you acquire this company. So you will notice this on one of the tutorial questions that are uploaded online. So which also indicate that when you're calculating the portfolio assets, you end up also performing the coefficient of variation to also identify whether it is best to actually acquire 100% of these companies. Whereas on others, you do not get to use the coefficient of variation because you are diversifying. If you are acquiring a company uh, in the same market or in the same sector that you operate in, therefore you also need to perform what we call the coefficient of variation. But if you are diversifying and you operate in two different sectors and you're not acquiring 100% of that particular company, therefore there's no need for us to perform the coefficient of variation for the portfolio. But however, if it is the case, therefore we then get to apply the CV. So over here, we then have the following activity that I took from one of the tutorials that we uploaded. So this activity then is different from the first activity that it is available there online, which then talks about another company acquiring 100% of another company. So, which means that on that activity, we then go and actually do what? Calculate the CV as well. But for this one, we cannot calculate CV because we are just diversifying. So we already have got multiple existing investment, and then we are trying to decide which between project one and project two, which project do we actually take that will actually then boost our investment by diversifying the risk and reducing the risk of by diversifying our portfolio and then reducing the risk within our portfolio. So the main aim of calculating as the portfolio expected return as well as risk is to actually identify if this will actually help reduce the risk and maximize the return or actually increase the risk and minimize the return. So over here, we then have this company called Bean Limited, which is a division of L Enterprise and has been allocated 5 million for capital expansion in the forthcoming year. The management of Bean Ltd believes that the company must spread its risk by investing in a project with a different risk profile and has identified two possible investments. The capital available to Bean Ltd is sufficient to invest in only one of the projects. So the following information have been provided. So we've got these two projects and we can only invest into one of these projects. And we've identified the probability that also comes with the anticipated return over this project. When there is an economic growth on an average of zero, we anticipate the probability of this occurring at 30%, and we anticipated the return of project one to be at 14%, of project two at 8%, and of existing investment at 6%. However, if the economic growth goes to 3%, the probability of this happening is 0.4% based on past event, and therefore the anticipated return is 10, and then over here we've got 16, over here we then have got 12%. And then when the economic growth goes to 6%, we anticipated that the probability of this occurring is actually 30%, and the anticipated return for project one is 8%, project two, 22, existing 16%. And we also have got the book value, which is the acquiring value of those assets. To say that when we invest in project one, the book value is 5 million. Also, the market value will be the same as the book value since we'll be acquiring this for the first time. And same applies to project two. However, for existing, when we acquired this project, the book value was 10 million or the investment was 10 million. And now the market value of this investment is sitting at 15 million. So when we do the portfolio analysis, we normally use what we call the market value so that they give us the correct, accurate figure that we can actually use to weight down the contribution by each project towards our portfolio, how much each project will be contributing based on its weight of investment. So here it says that the division manager has requested the accountant to determine which of the two projects should be accepted using the portfolio theory to accept the selection. So Bean Ltd is a risk averse investor. So a risk averse investor is someone who will only accept risk up to a certain point. They've got limitation. But if they are a risk taker, this means that they will accept the risk as long as there is higher return to match the risk associated with that. If they are risk indifference or risk neutral, it means that they only accept risks that matches the return, where the returns are actually higher than the risk. But risk averse, they can take a risk up to a certain limit. So this will also influence the decision that you'll have to take between project one and project two. So it says that using the above information, calculate which investment Bean Ltd should select in line with portfolio management theory. So the portfolio management theory requires that you calculate the expected return of each and every asset individually, as well as the variance and standard deviation of each asset individually. Once you do have all of this information, we can then go and then calculate what we call the covariance. So the covariance then measures whether the two assets actually move in the same direction or move in the opposite direction. So if the covariance is positive, it means that they move in the same direction, and therefore if it's negative, it means that they move in the opposite direction. However, from the covariance, we can use it to calculate what we call the correlation coefficient, which measures the relationship between the two assets. How closely are these two assets actually related, meaning that can these two assets be affected by the same economic factors? To say that if something happens in the economy, what is the likelihood of both of these two assets actually being affected? So the correlation coefficient will therefore tell us whether these two are positively related. And in most cases where the covariance is actually positive, we also expect the correlation coefficient to be positive. So this means that they will be related. However, if the correlation coefficient is greater than 1 or equaling to 1, it means that they are positively. And then if it is less than 0, it means that they are negatively related, positively, negatively related. So it is a strong negative relationship. However, if they are just greater than 1, they are just related but not strongly related. If it's just greater than 0 but less than 1, they are related but not strongly related. So you will notice that during one of the activities that we did during the class when we were busy explaining the concept of risk and return and expected return and standard deviation, I also used an activity where you were given the correlation coefficient but required to actually calculate the standard deviation of the portfolio, where this then become the substitute of the covariance, where you can be able to use the correlation coefficient to calculate what? The covariance. So if you notice this formula, it says that to calculate the correlation coefficient, you need the covariance of the two assets divided by the two assets deviation multiplying each other. So this means that we can reverse this formula by saying that the covariance is equaling to what? The correlation coefficient multiplied by the standard deviation. So here at the bottom, we then have two types of what? Of formulas to calculate the variance of the standard of the portfolio. So this is the first formula that we can use, which says that the variance of the portfolio can be calculated by the weight squared multiplied by the weight of first asset squared multiplied by the variance of the first asset plus the weight of the second asset multiplied by the variance of the second asset plus 2 multiplied by the weight of asset 1 multiplied by the weight of asset 2 multiplied by the covariance. However, if the covariance is not given, you are given the correlation coefficient, you can go and say that to replace the covariance, we're going to go and say that it's going to be 2 multiplied by the weight of asset A, then multiplied by the weight of asset B, and then multiplied by the correlation coefficient multiplied by the standard deviation, which will then gives you this formula that you can see over here on this side on my screen. So this is just sorry about this. This is the portfolio theory that, formula that you can also use to calculate the variance, to say that the variance of the portfolio, it is the weight of share 1 or of the weight of asset 1 multiplied by the standard deviation of share 1 squared, or the variance. So when you see this, it means that you can go and say standard deviation squared, or you can just go and say this represents the variance. And then you can just put the variance over here plus the weight squared of asset B squared multiplied by the variance and then multiplied by 2 and then multiplied by the weight of asset 1 multiplied by the weight of asset 2 multiplied by the standard deviation of asset 1, standard deviation of asset 2 multiplied by the portfolio of the two assets combined. So the correlation coefficient of the two assets combined. This then substitute what we call the covariance, because this is what gives you the covariance, which is the correlation coefficient multiplied by the standard deviation. And to calculate the expected return of the portfolio, it is the sum of the weight of an individual asset multiplied by the expected return of that individual asset. So meaning that we first need the expected return and the weight for that expected return. How much is the weight, and in terms of investment, how much will that asset be contributing towards the total portfolio? So we calculate this based on the market value of that particular asset towards the whole portfolio, which I'm going to explain this at a later stage. So let's take a look at our activity so that we can be able to assess this whole project and see which project is the likely one that the company is likely to choose based on whether it's going to add value and reduce the risk of the entire portfolio or either increase the risk. And then we'll accept based on those bases since our investor is a risk averse. So this means that they will only be able to take a risk up to a certain limit. So this means that we'll be looking in terms of investment that have got a lower risk, that will lower the risk of the entire portfolio. So over here on existing investment, we then have state of the economy being 0.3%, 6% growth, and the probability being 0.3, 4%, and 30%. So these are already in decimal format. So over here, we then go and say that the expected return will be the probability multiplied by the anticipated return, which then gives us 1.8%. We can repeat this for the two, which then tells us that during 3% growth, the expected return is 4.8. During 6% growth, the expected return is also 4.8. Therefore, we can calculate the entire what you call expected return of this project by saying 1.8 plus 4.8 plus 4.8. Therefore, this will give us a total expected return of 11.4%, which we can do the same for project one by going and say this will equal to the probability multiplied by the anticipated return, giving us 4.2. And then for uh, 10%, this will therefore give us an expected return of 4%. And then when it's at 6% state of the economy, then growth, we expect the anticipated or expected return to be 2.4%, and at the anticipated return of 8%. So this means that the overall expected return becomes 10.6%. And then over here, this side on project number two, we then go and say that the expected return over the state of the economy having zero growth rate is going to be 0.3 multiplied by 8%. And all of this will therefore give us the following figures. So 0.4 multiplied by 16 give us an expected return of 6.4%. And then once we complete the sum of all of this, this will then give us the expected return of this entire project, 2 being 15.4%. So by just looking at only the return, you will notice that project number two have got the highest return. However, we do not choose a project just only based on its return. We also need to assess its risk and also assess its we also need to assess whether by combining this with our current existing investment, will this actually yield a positive result or a negative result by looking at the entire portfolio risk. So from here, we then try to calculate the deviation for existing project. So when we calculate the deviation, we're saying the anticipated is 6% minus, so please the dollar sign. So I'm just gonna use the dollar sign to fix this amount so that it doesn't change on all when I drag down the formula. So over here, we're then going to say that from 6% to 11.4%, we then have a positive deviation of minus 5%. And then for the rest over here, we then have a deviation of 1%. And then I need to put this in two decimals so that we can get the accurate percentage. So over here, we've got a deviation of 5.4%. And then over here, we've got a deviation of 0.6%. And then over here, we've got a deviation of 4.6%, which is a negative because we anticipated 6%. However, the expected for the entire portfolio or entire existing assets is 11.4%. And therefore, we can calculate what we call our So on this point, we can calculate our variance per anticipated probability of outcome state of the economy. So we're going to say the probability multiplied by, in brackets, deviation to the power of 2. So normally you'll see that it's going to say 0.00. So you'll remember that our deviation is in percentage format. So our final figure will actually be in the 10,000 format. So we still need to multiply this by 10,000 to get the correct amount in percentage. So therefore, the variance becomes 8.75, and then we can actually go and do this for the other three as well. And then we can then try and calculate what? The variance in total. So the variance in total for this project becomes 15.24%. So over here it's 0.14%, over here it's 6.35%. You can still go and use your scientific calculator by doing the following. So I'm just going to try and move this to this side so that we can be able to use it on the other side without okay, I'm just gonna use it the same way as it is. So we are saying 0.3 multiplied by, in brackets, 30. Sorry, I'm thinking of the previous answer. We are saying now multiplied by minus 5 minus 5.4% to the power of 2. So you will notice that our figure is in 10,000 format, being 0.0008. So our first percentage figure will normally start over here, and then this will be representing the tens, and then this will be representing the ones, and this will be representing the decimals behind. So because now we're in the 10,000 format. If we're looking at percentage format over here, if the number behind the zero represents the tenth, and then over here it represents the what to call this, represent the ones, and then this then represent the decimals. So we just shift the numbers in that order when it comes to reading these decimals. So to be able to read this in 100% format, we then have to multiply this by 10,000 to be able to get the accurate figure. So therefore, in percentage, therefore this can give us what we call 8.748, which rounds off to 8.75%. So this is our what we call variance. So this is from this variance, we then calculate it the same way for the rest of these other variants. So we then calculate this the same way for these other three anticipated outcome, and therefore we get what we call the variance. And then we add the total of the variance by summing everything up to give us the total variance for existing projects or investment. And then lastly is to actually then calculate the square root, which we square root what? 15.24%, giving us a total variance of it's supposed to say 3.9 over here. So I'm just going to then fix this up. So the exact variance is actually 3.9%. So this is the risk associated with this investment. So our already existing investment have got a return of 11.4 and a risk of 3.9%. Then we can then do for project one and project two and then measure them against each other. And then after that, we can then combine them with our portfolio to assess if this is actually going to be a good thing, which one is going to add value to our portfolio. So let's start with project one. So looking at project number one. So on the project number one, we're then going to say that for deviation, it's actually going to be anticipated return minus the expected return. So this means that we're deviating by 3.4%, which is actually a negative, um, which is a negative outcome. So negative outcome meaning that from 14 to 10% we are going downwards. And then on the other side, you will notice that we are then have a positive outcome of 0.6% and a positive of 2.6 because the anticipated is 8 and the expected is 10.6%. And then we can then calculate our deviation by going in, sorry, our variance by going in, say, the probability multiplied by open brackets, our deviation close brackets to the power of 2, and then we said multiply by 10,000. This will then give you a final figure in percentage format. And therefore, we can do the same for the other three and say that for state of the economy at 3%, the variance is 0.4%. At 6%, the variance is 2.03%. Therefore, we can calculate this by saying equals to by saying this is therefore the sum of the three above, giving us 5.64%. So 5.64% is the variance for the whole entire project one, and therefore the standard deviation is therefore the square root of the is the square root of our total variance. So therefore, we can then have these as 2.37%. So this is our exact standard deviation for project one. And then we're going to go and repeat the same thing for project number two to calculate the deviation, the variance, and then the standard deviation, which is the risk of the entire portfolio. So this portfolio is giving us 10.6% with a risk of 2.37%. Remember, over here, we're not going to use the coefficient of variation because now we are looking at two different types of investment that are going to diversify our risk. We are not acquiring, this is just an additional project on the existing one. So therefore, we cannot go and use the coefficient of variation. However, we can only use the portfolio risk and portfolio return to assess if this one of the project, which project will actually then add value. So starting over here, project number two, deviation will then have 8% minus 15.4, giving us a minus 7%. And then we do the same for the rest. So this means that over here we then deviate by 1%, but it's not exactly 1%. So I just need to convert this into two decimals. So over here we're deviating by minus 7.4%. Over here we're deviating by 0.6%. Over here we're deviating by 6.6%. So from 15 anticipated now to 15%, we have got a negative outcome of 6.6% in terms of deviation, whereas over here we've got a positive outcome of 7.4% from 8 to 15.4. And then here over here we can then be able to calculate what? We can be able to calculate our total variance by saying it's equals to the probability multiplied by the deviation to the power of 2 and then multiplied by 10,000, which then tells us that in percentage format, the variation, so the variance is actually 16.43, and then for the second one is 0.14, and then for the third one is actually 13.07. This can then allows us to be able to calculate the total variance to become 29.64%, and therefore we can then calculate the risk to say that the risk is the square root of the variance. So the variance, square root of the variance, which then gives us 5.44%. So which means that for a percentage return of 15.4%, we expect for the expected return of 15.4%, the risk associated with it is 5.44%. So this means that now by looking at all of this, we cannot just go and choose because we do not know what will this project actually do to our existing. Will they increase the risk or will they decrease the risk of our portfolio? Therefore, for us to be able to identify that, we then use this information firstly to calculate the two things, the covariance and the correlation coefficient, where the covariance will tell us if these two type of assets move in the same direction or opposite direction, or there is no relationship at all between the two if it's at zero. Whereas the correlation coefficient will therefore tell us if these are positively related or negatively related. And it is important that when choosing project based on the covariance or the correlation coefficient, we choose the project with a negative covariance or correlation coefficient, meaning that this will then help us diversify our portfolio by reducing the risk, meaning that whatever happens in the market, it might only affect one particular asset, and therefore the other asset might still be able to perform better and offset all the what, all the losses made by the other project. So this is very much important. However, if you choose a covariance or a project with both positive outcomes, this means that when they both go down, they all go down, and therefore none of the assets will actually cover the loss of the other, which means that you are going to be losing a lot. So this is the same as the say of putting all eggs in one basket. So this means that when that basket falls, all of your eggs get crushed or get broken. So let's take a look at how to complete the covariance. So to calculate the covariance, you're going to use the deviation of the existing project, multiply this by the deviation of the project one, and then this will then give you what we call covariance, which is a variance of the two assets combined. So the two assets, variance of the two assets combined can be calculated by saying probability of the state of the particular outcome multiplied by the two assets variance, and therefore this will then give us the covariance. So to do so, we first need to identify what is our deviation of existing project one. So deviation is found over here. We then have it over here. So there's no need for me to recalculate this because it's already here. For project one under the state of the economy, it's also available over here. We then have 3.4%. So I can just drag this down since I'm using Excel to then actually give me the other figures that are above. So this means that for existing project, these are the deviation for existing project, and these are the deviation for for project number one. Therefore, we can be able to calculate the covariance by saying that it is the probability multiplied by this over here, multiplied by this over here. And then you will notice that our final amount will be sitting as well in 10,000 format because we multiply a percentage by a percentage. And therefore, we will have to say multiplied by 10,000 for us to be able to get the final figure in sorry about that, so that we can actually be able to get the final figure in percentage format. So therefore over here we've got minus 5.508%, and then we can repeat this for the entire project. So for the entire project, this is going to be the what we call the variance for this particular project, and therefore the total covariance is going to be the sum of these three, giving us minus 9.24%. So this means that these two assets do not move in the same direction. Our existing project and project one moves in the opposite direction. So this means that if we're looking to diversify, this is the likely project that we are going to accept. However, this does not end over here. We then still have to go and do what we call the portfolio risk and assess if the risk of already existing, which is sitting at 3.9, is it going to increase or decrease once we add project one on our existing project? And then we also do the same for project two. Is the risk of 3.9 going to increase or decrease when we add project 3. And then we're going to accept the project that is going to reduce our overall risk of our profile. But however, by only looking at this, we can already tell that the likelihood of project 1 decreasing the entire portfolio risk is high because they are not what? Related at all. They move in the opposite direction. This also means that when we calculate the correlation coefficient, is therefore also going to be what? To be negative. And remember the correlation coefficient, it is actually equaling to what? It is equaling to the deviation, all of this divided by open brackets, the risk of existing project multiplied by the risk of project 1. So this is what it will actually give us. So you will notice that over here, if we to run this backwards, you will see that it's gonna say -1%. So this means that they are perfectly negatively related. So this means that they are not related at all, meaning that factors in the economy will not affect these two assets in the same way. So this means that whatever affect the other will right, do not affect what? The other, except for general economic factors that affect the entire industry, all the industries within the country, mostly political issues. And then over here on existing and project 2, we also need to calculate the same thing, which is the variance, covariance for these two projects to be able to identify whether they move in the same direction and they are actually positively or negatively related. So over here, we're gonna then start by then going and saying that for existing, the deviation is minus 5.4 over here. And then for this one, it's actually minus 7.4%. And then I'm just gonna highlight the two and then extend so that we can get the other deviation. So this is how our current information, this is our deviation. So already these two negative, when we multiply them together, they're gonna give us a positive. So over here, we're then going to then say the probability multiplied by the deviation of existing, multiplied by the deviation of project number 2, multiply this by 10,000 to give us the final figure in percentage format. So therefore, this is going to be 11.988%. Whereas for the other state of the for other states, um, probable outcome, we then have 0.144, and then over here we then have 1.04, which then leaves us now to a total covariance of 21.24%. So this just tells us that existing project and project 2, they move in the same direction. This also means that when we calculate the correlation coefficient, they are going to be positively related. But how positively related? We are then going to say that this is going to be the covariance. All of these divide by open brackets, the standard deviation for project 1, so for existing, multiplied by the project 2 standard deviation. This will then give us the following figure, and then when we round this off, you will notice that it's going to give us a positive 1%. So this means that positive 1, this just indicate that they are positively um, they are strongly positively related. So this means that whatever factors affect existing project will also affect project number 2. So the likelihood of us accepting project number 2 are already down because we cannot put all our eggs in one basket because this is likely to increase our risk of our entire portfolio. So therefore, the only thing that we are left to assess at this stage will therefore be the return that the portfolio will earn as well as the risk over the portfolio. So let's start by calculating first the weight because the weight is what is actually important. So over here, I'm gonna then write and go and say that we then have over here what we call existing. So let me just write it over here. We then have existing, we then have project one. Over here, we then have project two. And then remember, I did mention that when it comes to this, we get to use the market values. So when we use market values, so the market value for existing is 15 million, and for these ones are 5 million each. So in total, the total investment value for selecting one of these projects will therefore be equaling to. So over here, I'm gonna then go and say that for existing project plus project one, we're then going to have 15 million plus 5 million, giving us this is gonna give us 20 million. And then over here for existing project plus project two, this will then also give us 20 million. So this means that both the market value of this project, when combined, they will have the same share. However, in terms of the weight, therefore, this is going to say equals to for project for existing, because they all share the same weight, so it's gonna be the same. So which means that over here it's going to be 15 million divided by 20 million. This is gonna give us 0.75. And then for this one is going to be the 20 million. So it's going to be the 5 million divided by the weight, which is the market value of 20 million, therefore divide by 20, giving us 0.25, which is still gonna be the same as well for this one. However, I'm just going to make a difference, assuming that this was 7 million. If this was 7 million, this means that the market value of existing project plus project two was going to therefore be 22 million. So this means that when you calculate the weight, we're going to have the weight, for existing plus project one. And then we're gonna then have the weight for existing plus project two. So which means that we're going to have two different weights, because over here we're then going to have this, then over here we're then going to say equals to 15 million divided by 22, giving us 68. And then over here we're going to say for this project we're going to skip. And then for project two, we're going to say 7 million divided by 22 million. This is going to then give us this figure. So let me also reduce this into decimals. So these were the figures that we're going to use. So this means that when we calculate our portfolio, we're going to calculate them based on this. For existing and project two, we're going to say under existing 68, under project two 32. And then for existing plus project one, we're going to say 75 and then 25. However, because they both share the same weight, project one and project two, therefore, the weights will still be the same in saying 15 divided by 20, giving us this. And then over here, 5 divided by 20, giving us 0.25. And then we can then be able to calculate return, uh, the expected return of the entire portfolio. So the expected return of the entire portfolio, I'm just going to write RP for the entire portfolio, can therefore be calculated as follows by saying that it is the weight. It says that it is the weight multiplied by the expected return. So we're going to start by existing and say that the weight of existing is 0.75, which represents 75%, multiplied this by the expected return of that asset, which in this case, the expected return of existing, we have calculated to be 11.4%. So we're going to go and say multiply this by 11.4%. and then plus open brackets, the weight of asset B, which is 0.25, multiplied by the expected return of that asset. So this we're looking at project one, which is 16%. And then close brackets. This then gives us a total. This then gives us a total expected return of exist of our entire portfolio, which the entire portfolio over here it's for existing project plus project one. So this is to say that the entire portfolio return when we accept project one, it's going to be 11.2%. Whereas if we go back to our existing, before we choose project one, it was sitting at 11.4%. So it just went up by a slight 0.2%. However, does not actually indicate that we should drop project one. We still need to assess the risk associated with this investment project. So over here, we then go and then do the one for existing, the expected return of existing project and project number two by going and say that it's going to equal to the weight of project of asset A, which is 0.75, multiplied by its return, which is 11.4%, close brackets plus open brackets, 0.25, which is the weight of project number two, multiplied by the expected return, close brackets. This will then give us 12.4%. So over here, you'll notice that existing is was sitting at 11.4%. And this time it actually did went down from 11.4 to 12.4% by actually a full 1%. So the expected return increased by 1%. So over the other one, it slightly decreased by 0.2%. So based on these two alone, still we cannot make a full investment decision to say which project should we actually add because already we're saying the likelihood is that we add what project one because it is not related to project to existing project because it will diversify our portfolio and reduce their risk because they move in the opposite direction. However, we still need to confirm that by performing what the total portfolio risk. So to do the portfolio risk, we're gonna need the covariance of asset A and asset B, which is for existing and project one, where the covariance is here for existing and project one, and then the covariance is here for existing and project two. So we can substitute all of this in the formula because we already have the weight of project one of existing project, and we also have got the weight for project one, and then we also have got the deviation for or the variance for project one, which is existing, and then we also have got uh, the existing project variance. So therefore, we can be able to use this on our formula to then calculate the total portfolio variance and then square it. So over here, we can then go and say STD, which is for standard deviation. And then we can indicate that this standard deviation, that we can then indicate that this for existing project and project one. So over here, we're then going to say equals to. So this is how we write this one down. So we're going to say equals to, say open brackets. We can say 0.75 to the power of 2 multiplied by, again, the variance. So in this case, under this, you can either go and select either the variance itself or either go and say 3.9 squared, which is still going to take you back to the variance. But however, the formula did not specify it because this can still be a standard deviation squared or a variance. So you can choose whichever you like. But if you see something like this just indicates a variance of asset A. So I will just prefer that you go and just select the asset of variance A, which is 15.24, to save yourself time and error. So 15.24 percent, we close brackets, and then plus the weight of asset B, which in this case is 0.25, close brackets to the power of 2, and then multiplied, all of this multiplied by open brackets. We are looking now for the variance of project 1, which is 5.64%. 5.64%. And then we go and say plus 2 multiplied by the weight of project 2 of existing project 0.75, again multiplied by 0.25, again multiplied by the variance, which is minus 9.24. So by the covariance minus 9.24. So over here, I can just remove the percentage since I've already put it, these other in decimals. So over here, you'll notice that the variance will come back as 5.24. So this is the variance of the entire portfolio. So this is the variance that we are going to get for existing and project 1. So over here, let's just say this is the variance, not the standard deviation, because we haven't square root anything. So this is just the variance. And therefore, the to actually then get the standard deviation, we square root the variance. This then gives us now annual entire risk of our entire portfolio being how much? 2.34%. And the variance is 5.4. There are no risk. This is the risk, which is known as the standard deviation. So the risk becomes 2.34% for existing project plus project 1. So when we go up here, we said that our risk was sitting at 3.9% and our return at 11.4%. By choosing project 1, we are now saying that the expected return will be now 11.2% with a slight decline of 0.2. However, the risk was sitting at 3.9, and therefore now it will be reduced to 2.34%. So this means that by looking at project 1, it already reduced the risk by a huge percentage. So therefore, this is something that we would like you to accept because it reduced the risk of the entire portfolio without actually affecting much of our expected return. So therefore, let's look at project number 2. So for project number 2, we're going to say variance for existing project and project number 2. I'm just going to copy this because I'm not going to change too many things. So over here, we're then going to say for existing project and the weight of existing project multiplied by the variance of existing project, then the weight of project number 2 multiplied to the power of 2 multiplied by the what? By the variance of its existing. So the variance of this one was sitting at 29.64. So that's the only thing that I actually need to change here, 26.9 or 29.64. So this is the variance of project number 2. And then over here, we then also need the core variance. The core variance over here for these two projects is sitting at 21.24. So I've got 21.24. And then we can calculate. This will then give us a total variance of 18.4%, and therefore we can calculate the square root, which is going to give us the risk. So the entire risk of the new portfolio will therefore be 4.29%. So this means that we went from 3.9% to 4.29%. So the risk of the entire portfolio increased. So looking at the way that the company is, which are risk averse, they are not going to likely accept project two because the risk have increased significantly, whereas on project one, the risk have decreased significantly without affecting much of the existing return. So therefore, the likelihood is that they will accept project two based on the fact that the risk of the entire portfolio will be reduced by 2.34. So we do not go for much about the return because the risk is also increasing as well. Whereas for project one, the risk is actually lesser compared uh, of already existing portfolio. So this means that this is the one that is likely to diversify our whole portfolio by meaning that when something gets to affect the already existing investment, the project one investment will not be affected at all and therefore will cover for the losses of project existing project. So therefore, this is what we actually get to use the portfolio management for. However, this does not end over here. We can then further go and do this and apply the beta, the portfolio beta. However, I'm going to leave that for you guys to further study this in your postgraduate study. So since this is your first time actually going through most of this topic in this detail, therefore, I am actually going to stop our lesson in this particular um, content or concept. So this means that for those who like to go further, you will therefore be able to consult with me and then I'll be able to share and explain to you how to actually go further and apply the beta, the single asset beta as well as the portfolio beta and how is it used to actually calculate or to actually express the volatility of the particular assets that you're trying to actually acquire, how risky is that asset compared to the market, and what is the risk of the two assets now combined in your entire portfolio. So we then get to use that, and also we can use that information to plot it on the secondary line market to assess in terms of looking at the risk-free and your current investment project and other, and see what will be the shift between your previous existing portfolio and your current existing portfolio using the beta method. So for this lesson, we are only going to stop here and we are just go. This is what you're going to be assessed on in your next assessment. Plus, please remember you will also be assessed on calculating your average historic return as well as calculating the return over the investment of the project using your formula where you get to be able to calculate um, what do we call this, where you're actually going to be asked to calculate the return over the project and then use that combine and then to calculate what we call the entire portfolio average return. And then you can use that as an anticipated return for that particular asset. So those are the things that you're going to be assessed on. However, to add on in that, you're still also going to be tested on the theoretical concept to see if you do understand this concept in terms of theory based. What is your understanding when we say that the two company, project one and project existing and project one have got a risk of 2.34 and existing plus project two have got a risk of 4.29%. Can you explain why which project will the company choose and the reason why. So you still need to be able to explain that project one does reduce the risk of the entire portfolio from 3.9 to 2.34%, which looking at well at the return, which are slightly affected. Therefore, project one is the likely one to be accepted as it actually reduces the risk of the entire portfolio. This means that it also increases the chance of us actually earning what the expected return over our investment because there is going to be less variation in terms of what we expect based on the risk of the entire portfolio. Whereas on project number two, it increases the risk of the profile of the whole portfolio, also increasing the likelihood of variation in terms of what we expect. And therefore, this is not something that the company will actually take as they are risk averse investors. So that is what you should be expected to explain on this particular project. So this is all for today's lesson. So if you do need anything, feel free to send me an email. I will be able to reply and help you whenever you need help. We will schedule a Teams meeting and then I'll be able to assist you guys in terms of what clarification you actually need or whatever you asked during your studies. So all the best for those who are graduating. Congratulations. Enjoy the rest of your day and weekend. And we shall see each other after the ceremony as well and in class. Thank you very much.